Hello and welcome to this session in which we will discuss the bunching of itemized deduction. A prerequisite of this session is having a good understanding of the concept of itemized deduction. So if you don't know what itemized deduction is, if you are not comfortable with itemized deduction, please stop, look at the prior recording to get an idea what itemized deduction. Because itemized deduction is a tax planning technique. It means you have to have a good understanding. Once we are looking for planning, it means you have a good understanding of the basic. And this strategy is useful for those whose itemized deduction are slightly below the standard deduction threshold. So we have the standard deduction, and you can only use the itemized deduction if your itemized deduction are above the standard deduction. So if they are below the standard deduction, you will take the standard deduction. How about if your itemized deduction are almost to the standard deduction but below it? What you want to do, you want to find a way to get your itemized deduction above the standard deduction so you can take the itemized deduction. So that's the plan. So what do? You are going to consolidate, you are going to bunch, you're going to put together certain deductible expenses in one tax year. So what you do, let's go back to this line here, and we have the standard deduction, and you're right below the line. So what you do, if somehow you can bunch few additional itemized deduction to surpass, to go over the standard deduction, therefore you can take the itemized deduction, and by doing so, you can optimize your tax savings. And this can be an effective way to maximize your tax deduction over a 2-year period, especially if you are near the standard deduction. So this approach requires careful planning and consideration, and this is what we will discuss in this session. Let's go ahead and get started. Before we proceed any further, I have a public announcement about my company, farhatlectures.com. Farhat Accounting Lectures is a supplemental educational tool that's going to help you with your CPA exam preparation as well as your accounting courses. My CPA material is aligned with your CPA review course such as Becker, Roger, Wiley, Gleam, Miles. My accounting courses are aligned with your accounting courses broken down by chapter and topics. My resources consist of lectures, multiple choice questions, true-false questions, as well as exercises. Go ahead, start your free trial today. So how bunching itemized deduction operates? Like bunching, putting together. That's what bunching is. So taxpayers accumulate potentially deductible expenses such as charitable contribution or medical expenses or state taxes to do what? Into a single year. So they will make 2 years worth of donation in 1 year. To do what? To increase their itemized deduction for that year. However, bear in mind, this strategy requires financial planning and the ability of front-load expenses. It means if you want to make the charitable contribution, you have to pay for it. If you have to pay for it, well, for one thing, you have to have the money. That's one. 2, if you pay for it this year, remember, next year, you're not going to have it. So you have to carefully plan in which year those deduction will benefit you more. Bunching these expenses for that year, the whole purpose of it is to do what? Is to exceed the standard deduction. And the following year, when the person itemizes, guess what? They opt for the standard deduction because they lost some of the itemized deduction in the prior year because it was beneficial for them. The best way to illustrate this is to take a look at an example. Let's assume Maria Smith, 45-year-old single, is contemplating how to optimize her tax deduction through charitable contribution. And charitable contribution is a good example. Why? Because you can choose when you want to donate to charity. You do have that option. When you pay your state taxes, it's different. When you pay your property taxes, it could be a little bit more challenging, a little bit more difficult. And we're going to discuss this. But the reason to start with charitable contribution, because if you don't want to, you don't have to. If you want to donate, you can donate. If you want to donate more or less, it's up to you. So that's why it's an easy way to do what? To use it as an example here as well as the real world. Her potential itemized deduction for the current year and the next are projected to be the same, with the exception of her charitable contribution, which she can control. So her state and local taxes are $6,000. Interest expense on the home is $7,000. Charitable contribution planned annually $2,000. So total potential itemized deduction without the charitable contribution is $13,000, which is the taxes and the interest. Maria is considering 3 options for making her $2,000 annual contribution. Option 1, $2,000 in year 1, $2,000 in year 2. Option 2, keeping all the contribution. Option 2, making all the contribution in year 1. Option 3, making all the contribution in year 2. And we're going to assume that the standard deduction for a single taxpayer, let's assume year 2023, it can be different, it could be anything for any particular year, is $13,850. And we're going to assume the same for year 2. So what should Maria do under those circumstances? Option 1, if she takes $2,000 in year 1 and $2,000 in year 2, what will be her total itemized deduction? Well, it's $13,000 plus 2, altogether 15. In year 2, her total itemized deduction will be $13,000 plus 2,000. Her itemized deduction will be 15. In both years, the itemized deduction will exceed the standard deduction of $13,500. What does that mean? It means if she keep them every year, she can take the itemized deduction. Now, let's take a look in total, just in total, to see how much deduction over 2 years. Over 2 years, just kind of, so let's look in aggregate. She takes $30,000 in deduction. Okay, let's opt for option 2 and option 3. In option 2, she's going to make the whole deduction in year 1, which is a whole charitable contribution in year 1, which is $4,000. Her itemized deduction will be total 17. For year 2, will be $13,000. Now, because what happened in year 2, she lost the $4,000. She lost the $2,000 because she made it in year 1. Now, if we look at in year 1, her itemized deduction is $17,000, exceeds the $13,850, which means what? It means she can take the itemized deduction. In year 2, she does not exceed the $13,000. Therefore, what she's going to use the standard deduction. Well, over a 2-year period, what's going to happen is this. She's going to have $17,000 in year 1, $13,850 in year 2. So in aggregate, notice she has $13,850, just in aggregate. So notice over 2 years, she has an $850 extra deduction. But the true benefit of this is when she takes the deduction in year 1, she's going to get the savings earlier. Savings earlier means what? You remember what we talked about, shifting income and expenses. You want to accelerate the deduction. So obviously year 1, taking the $17,000 is a better option. And it's a better option for year 2 because in aggregate, you will take an additional $850 over a 2-year period in deductions overall. Option 2, which is nothing in year 1, which what's going to happen is she's going to take the standard deduction because $13,000 is not enough. Then she will take in year 2 the $17,000. Between option 2 and option 3, when you include the time value of money, you want to take option 2, which is year 1. Why year 1? Between option 2 and option 3, option 2 is better. Why? Because you get your deduction earlier. Remember, we want to accelerate our deduction because of the time value of money. Now, conclusion, option 2 and option 3, they are equally at face value beneficial, but if you factor the time value of money, option 1 is better. Both options allow her to exceed the standard deduction in one of the 2 years by bunching her charitable contribution into 1 year, either 1 or 2. She can itemize deduction in that year to exceed the standard deduction while taking the standard deduction in the other year. And this strategy will maximize her deduction over a 2-year period. One more time, if you want to choose, if the question is between option 2 and option 3, option 2 is better. The earlier you can take the deduction, the better off you are. Let's talk a little bit more about strategies for charitable contribution. Charitable contribution, as I mentioned at the beginning of the lecture, they provide significant tax deduction because it's your discretion how much and when you want to make this. So employing a bunching strategy is not a bad idea. It can lead to substantial tax benefit. And this is your job as a future CPA, is to advise your client, is to advise them what to do in terms of, let's talk about 2-3 year plan. How much are you planning to donate? Let's see if we can shift that donation around to maximize our tax position. So understanding the limitation also is important, because there are certain limitations we're going to discuss briefly, such as in the choice of property. When you donate cash, it's different when you donate stocks. So you have to take all of this into account. For example, there's an AGI limitation. There are limitations on the amount of contribution can be deducted based on your adjusted gross income. And we covered this when we looked at charitable contribution itemized deduction. You have to be very comfortable with this. For example, total cash contribution to qualified charities can be deducted up to 60% of AGI. For donation of capital gain property like stocks or real estate, the limit is generally 30%. Now you can elect the 60% limitation. The taxpayer have this option to elect a higher deduction of capital gain property. If the election is made, the deduction is based on the property adjusted basis, not fair market value. It means the property is at a loss, basically. This choice might be favorable if the adjusted basis is higher than the fair market value, or if maximizing the deduction amount in a particular year is crucial. Now bear in mind, if you have stocks that have unrealized loss, if the stock has an unrealized loss, what should you do? A better strategy is to sell it. Sell it. What can you do when you sell it? When you sell it, you're going to be incurring capital losses. What can you do with capital losses? The first thing you would do is you will offset capital gain. If you have any capital gain, let's assume you don't have capital gains. What you do, you can still take $3,000 of deduction against your regular income. So sell it, take the loss, contribute the cash if you have stocks with losses. Now you also have to be familiar with long-term and short-term. We're not going to discuss this in here. Go to the charitable contribution session, but you have to be familiar with those. Also, property taxes. The bunching strategy can be also applied to property taxes, allowing taxpayers to maximize their itemized deduction in a particular tax year. What's the concept? The concept is to shift, is to make your payment of property taxes from one year to another to increase the amount of itemized deduction in a particular year. So what you do is, if you have year one and year two, and in year one you have to pay $5,000 in property taxes, and in year two you pay $6,000. You are responsible for $6,000. Either take payment in year two, shift it to year one, or usually what you do is you'll take year one, shift it to year two, because prepayment, it may not be possible, but shifting it will be possible. So that's what you will do. The basic concept here is the taxpayer can shift the payment of property taxes from one year into another to increase the amount of itemized deduction. Same concept. You have 2 years, year one and year two. Make the payment for year one and the payment for year two, bunch them together into into 1 year, or bunch them together into year two. A taxpayer owes $4,000 in state and local property taxes in each year. What's the strategy here? Instead of paying year one property in the same year, the taxpayer waits and paid January 1st of year two. Then that $4,000, it belongs to year one, paid in year two, it's a year two. Then pay year two on schedule in year two. Then you pay year two property as usual in year two. Now you have 2 payments in the same year. In year two, the taxpayer will have a total of $8,000 in property taxes. Now by doing so, they can claim $8,000 as an itemized deduction, but you have to take into account here if there's any penalties if you pay late. You have to take that into account. This strategy is beneficial if the total itemized deduction, including bunching property taxes, exceed the standard deduction. So you would use this only if you're going to get what? Above the standard deduction. Few things you want to be aware of when it comes to state and local taxes is there's a $10,000 limitation. It's important to remember there's a cap on the itemized deduction for state and local taxes, which include property taxes. So the SALT cap limit the effectiveness of bunching property taxes, especially in areas of high taxes. But places like New Jersey, property taxes, you pay way above $10,000, like easily. So you don't need to bunch anything, but you are limited. Although you pay more, you can only take $10,000. Also, you have to take into account if there's any penalties, because the county, the city, the state, they might charge you a penalty for paying late. You want to bunch them, but if you pay late, you may get a penalty over there. So you have to look at the net tax benefit. You have to look, okay, what's my benefit and minus the penalty? Because if you are charged a penalty, You have to see what's my net benefit and is it worth it. Net benefit for this, net benefit for the bunching. You can do the same thing for medical expenses. Now, medical expenses, you have to be careful because sometimes you cannot plan them. But there are certain operations, certain medical expenses that can be planned. So you have the opportunity to maximize your tax deduction by strategically planning those expenses, especially when these expenses are significant and elective in nature. So if you need a necessary operation in year 1, you cannot defer it for year 2. But if it's a hip and knee replacement, you can do it. Orthodontics for children, LASIK eye procedures, those are optional. So what you do, you want to time the prepayment if there's any time the payment basically. Taxpayer can combine medical expenses from multiple years into a single tax year. This is particularly useful for elective procedure that can be scheduled at the taxpayer discretion. So expenses prepaid in the current year for medical procedures for the next year are generally deductible in the year they are paid. And this can be done, pay them through cash or credit card payment. If you know you'll have significant medical expenses next year, you might choose to prepay them in the current year to maximize this year. Remember, for medical expenses, you have to go above 7.5 of adjusted gross income. So there's another limit. So you have to look at what's my adjusted gross income this year, what's my adjusted gross income next year. Maybe this year I have a low adjusted gross income, so I should pay my medical expenses now. Or maybe next year I'll have a lower adjusted gross income. Therefore, it's better off keeping my medical expenses for next year because I'm going to exceed the 7.5% of my adjusted gross income. So that's why you have to be comfortable with all the rules about all the rules for the deduction. Let's take a look at a multiple choice questions from farhatlectures.com. When employing the bunching strategy for property taxes, what is the critical factor to consider? In other words, what am I looking for if I'm bunching? Is it worth bunching or not bunching property taxes? Do I have to consider the $10,000 cap on state and local taxes deduction? Do I have to consider the 60% AGI limit on property tax deduction? There's no such thing as 60%. This is for cash charitable contribution. The ability to deduct 100% of property taxes with no limit. That used to be the case. And by the way, President Trump put that limit. Now, why did President Trump put that limit? One of the political argument, again, I'm not adopting it. I'm just telling you why. Because in places like New York, New Jersey, where they don't vote Republican, they don't vote for Trump, the property taxes are high, and people used to enjoy a large deduction. So what they're saying, President Trump did this on purpose to penalize them. Again, this is just, I'm not adopting the story. I'm just giving you more information to put things into perspective. So that's not the case. It used to be the requirement to pay property taxes biannually. You can pay your property taxes biannually, quarterly. It's between you and the county. So you have to keep into account that there's a $10,000 cap on that deduction when you are taken into account. So when you're looking at a simulation or a multiple choice and they gave you property taxes of $15,000, you cannot include this. You are limited to $10,000. Keep that in mind as you're working MCQs and simulation. What should you do now? You want to go to Farhat Lectures and work additional MCQs. That's going to help you with itemized deduction, bunch and itemized deduction. If you're studying for the TCP exam, the CPA exam, or any other professional certification like the enrolled agent. Good luck, study hard, and of course, stay safe.